This is Terrence R.J. Banks with Information Age Financial Solutions, coming to you with an article I read from Yahoo Finance about public pensions and why so much stuff is talked about what's going on in terms of illnesses and different things in the economy. With this many people being unemployed, tax revenue is not being calculated, especially for states. And this article actually was really good because at least it's touching bases, and I'll probably do another article about how this is going to affect the baby boomers as well. But as always, I put a link inside the description. I'm going to dive right into the article. Public pensions face reckoning from equity route tax losses. Let's get right in. U.S. public pensions suffered a double blow from the coronavirus pandemic, losing hundreds of billion dollars in equity market route just as unprecedented revenue losses piled up for governments that pay into the funds. Funding levels will be under stress because of losses in financial markets, and at the same time, governments may struggle to make up the difference as the economic shutdown to stem the outbreak slashes their income. In March, Moody's Investors Service estimated public pension investments losses were nearly $1 trillion during the first quarter. The S&P 500 index plunged the most since the Great Recession. Equity markets have since rebounded in April, and the Moody's composite used to make the projection now implies returns of negative 9% instead of negative 21%, though the virus continues to inject jarring volatility into markets. Without a dramatic bounce back of investment markets, 2020 pension investment losses will mark a significant turning point where the downside exposure of some state and local governments' credit quality to pension risk comes to fruition because of already heightened liabilities and lower capacity to defer costs, says Tom Aaron, Vice President at Moody's Investors Service. State and local governments have a combined $4.1 trillion in unfunded retirement liabilities. And these numbers are so astronomical that we just take them like it's common sense and commonplace. Again, 4.1 trillion unfunded liabilities before the pandemic hit. This is before the pandemic hit, according to Federal Reserve data. While public pensions hadn't fully recovered from investors' loss and inadequate government contributions after the last recession, I'm going to say again, while public pensions hadn't fully recovered from investment losses and inadequate government contributions after the last recession, some states had made plans to put more into pension funds in the coming year. Reduced payment. New Jersey suffers one of the worst funded public pensions in the nation, but the fund recently had made some gains. It held roughly $800 million more in cash at the end of February compared to the same time last year. Governor Phil Murphy's proposed budget included a record $4.6 billion payment into the pension system after years of skip payments and underpayments. That historic contribution paid would still fall $1.5 billion short of the actual requirement. The fund did not respond to a request to comment, and probably that's been going on because a lot of real estate was being done in New Jersey during this particular time, and which states don't talk about this, but a lot of state revenue is based on real estate taxes that they can put out to the population there. So it didn't, and it's just fascinating to see these different things and how we're only focusing on one part, but realize that this was teetering well before the illness event. So Keeveley recently worked to help Democratic Senate President. That payment would surely be reduced, said Richard Keeveley, who served as New Jersey Budget Director under Republican Governor Tom Keene and Democratic Governor Jim Fiaro, and the shortfalls in the pension liabilities will increase. Keeveley recently worked to help Democratic Senate President Stephen Sweeney craft a plan to cut the cost of public employee benefits, pensions, and benefits. On Wednesday, the New Jersey Treasury Department said it expects to see the impact from COVID-19 materialize in recent revenue figures next month, warning of a significant impact on tax collections. We have extended the fiscal year in order to get a better handle on our revenue situation, so the administration and the legislature can map the best path forward to meet our obligations, which includes the state's pensions contributions, said Jennifer Skinner Attorney, a spokesman for the state Treasury Department. Declining revenue. In Illinois, Governor J.B. Pritzker's administration have been working on plans to address its massive retirement debt, which has long been a drag on its credit rating, leaving the state only one level above junk. Now the state is facing a massive decline in revenue that can make it even harder for it to make up the $137 billion owed to the state's 5 retirement funds as of June 30th. In his 2021 budget address in February, Pritzker outlined his plan to use $100 million of proceeds from his proposed graduate income levy to pay down pension debt if voters approved the tax structure in November. I always think they propose more taxes to create a problem of insolvency. It's fascinating, but it's the world we live in. Joining spokesman for Pritzker didn't immediately respond to email requests for comment on Tuesday. Pritzker said Illinois is facing a very, very difficult financial challenge. This was, again, before COVID-19. Painful choices. Public pension officials are watching their liquidity closely, hoping to avoid the painful decisions some funds had to make during the last deep recession in 2008 in order to pay bills like benefit checks for retirees and capital calls for investment partners. The biggest reason you need liquidity is to make sure you can pay the benefit payments that you're committed to paying, said Kristen Doran, head of public funds at pension consultant Aon PLC. In this environment, there's a lot of uncertainty. Contributions that are expected from the employer could be stressed. Again, I want to reiterate, these states do not have the ability to print as government does. Maintaining enough cash on hand is essential for a pension fund, especially during a downturn. It ensures funds won't have to sell assets into down markets, a fate the California Public Pensions Retirement System fell victim to during the 2008 recession. CalPERS, the largest fund in the United States, said saw its daily market value plummet about 17% from more than $402 billion in January to about $335 billion in March. It's since climbed to about $372 billion as of April 14. The fund learned from its 2008 experience when it had to sell assets in plenty markets and meet capital calls. By showing the period in which employers had to pay liabilities and calculate contributions more conservatively, said spokesperson Megan White. The $53.6 billion Los Angeles Employees Retirement Association has lost roughly 12% or $7 billion in market value since the end of December, though it's sitting on $2.2 billion in cash, 8 times its target. We're very focused on our cash, said the fund Chief Investment Officer Jonathan Cagle. Cash is something that we monitor and is something that we do on a daily basis. Liquid assets. Since that recession, many public pensions keep more cash on hand and lean more on government bonds that can easily be unloaded if markets go south. Doe said, even in a downturn, a combination of short-term holdings and cash flows are typically enough to get by, added Jean Piri-Albury, Associate Director of State and Local Research at the Boston College Center for Retirement Research. That means, for the most part, public pensions aren't an immediate risk of failing to make benefit payments, Berry said. In a worst-case scenario, they could sell assets if needed, he added. It's important to recognize that the pension fund challenge is a long-term issue, not a short-term one. Aubrey said, when the dust is settled, we'll have to revisit the issue of pensions and serious questions we ask about the future and financing of these plans going forward. I tell you guys, I've said it before and I'll continue repeating this, the public pensions, baby boomers, and Social Security and all these other guarantees that we've applied, it has to be looked at. And with stuff like this that's going on now, it definitely needs more scrutiny, and we really need to be prepared mentally, and our families prepared for the challenges that's going to come and continue to occur, especially during this particular crisis. If this video has been any value to you, please subscribe, leave some comments. Until my next video, I'm out.